Okay, so based on the previous lesson, it's hopefully you guys have watched all the videos, and if you haven't, then you definitely should before watching this one. But basically, I'm just going to do a quick recap of what it is that we need to have finalized from our previous lessons. So we went through the leverage, we went through what it is to use higher or lower leverage and what it means for us as retail traders who either have a decent sized amount of money or a small sized amount of money, and how that reflects based on the leverage we have to use, because sometimes we'd be forced maybe to use a higher leverage because we have small money as a capital starting amount, and then we can make some good trades because we're not limited by the lot size imposed by a smaller amount of leverage. Okay, and then we learned about the risk reward ratios and what those risk reward ratios are. We've probably all seen a chart similar to this and how that would impact the outcome of each trade and the win rate versus the risk versus the reward that we take, and how we can actually use that to our advantage using not just variable risk but static risk. If we are knowing what we are doing, we'd be using static risk later on possibly, or some kind of dynamic approach where we use a blend of the two, but starting out we should all be using basically variable risk. I did add another one here that I had. So basically this is the same thing. This is just based on a high risk. So those of you who, it's not something I would ever do, but I just sort of illustrated it here where we took 5% on every single trade on a static risk, and based on a variable risk we did 3, 4, and 5%, and then we had the outcomes over here. For a 1:1, we lost 30% of the account if we risked, it's based on the same other two charts, but basically 1:1, we lost 30% on 5%. And if we were using variable risk, we'd only lose -2. I'm sure as we go higher into the R ratios, we do gain more money, but at the same time, how possible is it, or likely is it, that we're going to be hitting 1 to 3 and 5 plus on every single trade? Because starting out it's probably quite difficult to get even 1 to 3. So generally we'd be starting at like 1 to 2. 1 to 3 would be sort of the sweet spot of where we are working for our trades, and then working our way up as we get better at trading. But yeah, you guys can come and look at those things. I'm not going to spend too much time on those. And then we learned about the journaling stuff, and you should have or had some sort of look at this PDF over here and the impact of this PDF, because this PDF is a book that's a handbook. You don't have to read it from cover to cover. You basically should just select what maybe you feel is downfall on your side. Lesson 2, we discussed what the abbreviations are and what they represent to us as indicators. So if you haven't yet started learning them, definitely now is the time, but there's quite a lot of them, so it's best you do start learning some of them. Take like maybe 5 a week or whatever, 10 a week, and just remember them, say them out loud or write them down, or recite or read and recite them, or whatever, however your learning process is. So you should be doing that. And then we talked about what it is to have a trading system versus a trading strategy. Now, I just wanted to bring this up. It's quite important. So what we learned about the market conditions, where we spoke about consolidations, expansions, retracements, and reversals, that is not, how can I say, maybe a strategy as such. It's more of a mindset approach to what we see with our eyes on the chart. So it's sort of a process of a step to get towards a setup on the chart. So we look at the chart, we sit and we say, okay, based on the 4-hour or the 15-minute or whatever time frames you are looking at, step 1 or one of the very first steps should be maybe finding what condition the market is in as sort of a step of your trading system. Because once you can identify the step or the process that we are in, or the cycle or the phase, then you can move on to what your trading strategy is and how you find entry. But in order to get us there, we need to have a trading system, and part of maybe one of the steps of your trading system should be identifying one of those market conditions. And as we go on and learn new things, I'll occasionally revisit what it is to be building a trading system, because it's like an ongoing process. We should have all started writing something down, typing something up, drawing pictures, diagrams, whatever, however, you learn. We should all be doing something to start that approach to being traded, because at the end of the day, we're all here to learn and become better, or solidify any previous understandings we already had about ICT. But it's a bit more in depth when it comes to the learning process, the journaling of it, and developing that peace of mind that you get when you got where you need to go to have a trading strategy. Okay, so without any further ado, I'm going to continue over here. We learned about the cycles of phases. Again, remember this is in Notion, so I do share the link for you. It's best viewed in Notion because it's very structured in this process over here, but basically this is what we learned regarding the previous lesson, and it is a building block towards understanding, what the algorithm kind of does. The algorithm being the IPDA, which stands for the Interbank Price Delivery Algorithm, which is this little guy over here. That is your interbank price delivery algorithm over here. That is the nickname or the name attached to what ICT Michael Huddleston calls the algorithm. Okay, it could be called something else entirely. Maybe he developed it, maybe he didn't, someone else did, but he nicknamed it the IPDA, and that's what we learn it as. And it is based on AI, which is artificial intelligence, obviously, and it's AI, so it's electronic, and there's less involvement in terms of human interaction. So it's all electronic, and that means that price is now more efficient. So if you looked at charts a couple of years back, 20 years ago, the price was not as efficient as it was now. So as the technology grew, basically the markets became more efficient. So you can go through all of these concepts over here. You should already understand basically what they all mean. But like we said, expansion, order block at a near equilibrium point, retracement, which is generally some kind of maybe liquidity void that was created from the expansion, and prices retracing into that liquidity void, maybe possibly back to an IRL or a IRP, which is an institutional reference point or liquidity reference point, and then basically price retraces to efficiently traded levels, or inefficiently traded levels rather. And reversals, obviously reversals, there needs to be some kind of liquidity pool, and price moves against the current direction. So basically that current direction, depending on what time frame, obviously if you're looking at a 1 minute, 5 minute, lower time frame stuff, one retracement could be another reversal, one reversal could be another retracement, but generally based on the higher time frame is where our bias would come from. So against the current direction. So if your bias is coming from where it should come from, which is daily, weekly sort of areas as retail traders, then anything against those two time frames would be against the current direction. And then you're going to get turtle soups, which is a fake move above old highs or outside of a consolidation, and that's where you get or anticipate reversals. And we'll learn a lot about reversals because reversals is my favorite thing to trade. So I love reversals. My setup that I look for every single day on the charts, Monday excluded and Friday excluded, so Tuesday, Wednesday, Thursday, I'm basically trading turtle soups, reversals, and either prices reversing back into the trend or against the trend, and I'm trading those reversals. Consolidations, well, we know what a consolidation is. Okay, so like I said, one of these elements can be part of a strategy. All we need to know is basically one of them, and we can trade them and do it consistently. So basically that's what we said. Okay, so now I'm going to go on over here, and what we said about these items that we learned: consolidations, expansions, retracements, reversals, etc., etc. Basically, you've probably heard the term Judas swing, power of three, AMD, which is accumulation, manipulation, distribution. So basically that is when price comes into the London Open, expands away from the Asian range over here, and then price either decides to expand and retrace and expand again, or expand and reverse and expand lower or higher. Okay, and generally the retracements or reversals come at the London Open, New York Open, or New York Open, London Open. No, in no specific order, but that's basically the structure that is created. You know, I'm not talking about structure as in swing highs, lows, and what you know about structure, but the actual how the market works, if we could call it that, and then that is our price delivery model that we understand. So that's why it's quite important, because that is how price is delivered. So before, like order blocks and swing highs and turtle soups and internal range liquidity and anything else you're going to learn in the future, before that's even thought of or looked at on the chart, we need to understand that that is how price is delivered to us before it's delivered. You know, because at a retail level, we're only seeing the transactions that have taken place after the fact that they have taken place, because the market moves because of the market makers or institutions moving price, not because retail traders are moving price. Okay, so that was just a quick recap of what it is that we have learned. So I am going to take some questions later on, but there is quite a bit to get through, so I do want to just have a bit of juice in the beginning of this lesson. Tevakaran, I see your hand is up. I'm going to take a question now. Well, let me just get to your question. Do you want to answer now or ask now what you want to ask before I go on?
Okay, I just have a doubt. Maybe if it is fine for you, we can discuss before 15 minutes before we close the class.
What is your question regarding?
My question is regarding the market phases, right? Expansion, retracement, reversal, and consolidation.
Mm-hmm.
Uh, uh, in expansion, we have marked the reference point as order block or order block at near equilibrium, right? For expansion.
Okay.
But when price comes to order block, actually my query is ideally consolidation is where the order block resides, right?
Sorry, where the order block does what?
I mean, the order block here, it is marked as to expansion, right? Isn't that order block comes under consolidation?
I don't quite understand the question.
Okay, let me rephrase it. So order block is basically some pending orders which is still waiting to be fulfilled, right?
It is? Who said that?
Uh, I mean, that's my understanding. That's not order block, is it? Or
What, pending orders?
yeah, pending
Well,
orders. It could
it could be, but it also could be because it's a reference point that when price returns to a previously created order block, being bullish or bearish, that there will
hmm,
be possibly resting orders near that level. So yes, in a way, maybe not when it was created, but after the fact it was created.
okay. So, so mostly the pending orders or more number of orders will be created during consolidation phase only, right?
So pending orders, obviously, when you think about pending orders, where they are, where would pending orders be in terms of the eyes of the general retail traders? Is above swing highs, below swing lows, above consolidations, and below consolidation. So that's what really where pending orders would be. You'll learn more about like where to identify these zones of pending or resting orders when we talk about and discuss internal and external range liquidity.
Okay, fine then.
So I think maybe your answer isn't quite answered, or sorry, your question isn't quite answered right now, maybe, Tevakran, but I think that it could be answered possibly in the next 2 or 3 lessons. So maybe write that down, that question, and if you still have that
Okay,
question that's not answered, maybe in like, for a week from now, so maybe like next Friday, once we've done another few lessons, then I think we should address it. But for now, I think we should just hang on and see that if we continue, maybe that question will be answered.
okay. Thank you.
Cool. Mashoto, sorry, Mashoto. Oh, sorry if I butchered your name there.
I,
Do you have a question?
yeah, no problem. It's Mashoto. So I have a question on the difference between retracement and reversals. I think in my mind, I just like used the terms interchangeably and thought they were kind of the same thing. Um, so the way I'm understanding it now, I just want you to confirm is that now the retracement is when price goes back to like fulfill like an order block or an inefficiency that was created when it expanded out of the consolidation stage, right?
Correct.
So
That's
now,
retracement. Yes.
yes. So now a reversal, is this now just the point at which the reversal then changes, I mean, the extension changes direction into the reversal phase? Like just the tip of like the bottom, for instance, if price was going down. Is that what we would call like a reversal, or a change in direction based solely on the higher time frame and the directional bias of the higher time frame?
Okay, so
Like
it's
I'm struggling to find between the two which one I think I need to cement in my mind as the reversal.
okay, so that's a very good question from your side, and it's something I can address quickly. But we shouldn't spend too much time on, what's really correct, what's not correct in terms
Okay.
of identifying the two, because that will come later once you understand how to read like the entirety of price action. So let me just
Okay.
quickly draw this out for you. So let's say that over here, let's just say that this over here is maybe like a daily chart or a 4-hour chart, price action over here. And then maybe over here, price decided to go higher, do some kind of whatever price action, and then start to sell off over here. Okay, so
Mm-hmm.
maybe that's like a daily or a 4-hour. Now, if we were to go to a lower time frame, it's possible that on the lower time frame in this section of price action, there was
Mm-hmm.
likely to be some kind of, I don't know, consolidation, maybe on like a 1 hour or a 2 hour or a
Yes.
30-minute or something. Okay, so there was consolidation and then price decided to expand lower
Mm-hmm.
over here. Okay, so we got consolidation and then expansion. So if price decides over here to, basically reverse back and come back there, then this is expansion, and then this would likely be retracement because the
Retracement.
daily and the 4-hour is still looking bearish. So then
Mm-hmm.
our bias decides which direction likely is to go and continue going. So it's likely to have a retracement after
Mm-hmm.
expanding. So then maybe price either just continues to expand lower like this,
Mm-hmm.
or it could possibly decide to consolidate and then expand lower. Okay,
Yeah.
but still our bias comes from the higher time frame, and there could be a reversal above this small liquidity point over here, or any consolidation that formed maybe some little collection of orders, and there was some maybe equal highs that formed on the lower time frame. Our bias is still bearish, so the reversal point could likely be this swing over here that was created to go higher, or this guy here where we said that this was the liquidity pool, and maybe
Mm.
over here was some kind of gap or void or order block that it retraced into. Okay, so one time frame tells us it is just retracing. Another time frame, possibly at this point over here, tells us maybe on the 1 hour, the 15-minute, that it's consolidating. However, the overall decision of bias comes from the higher time frame. That doesn't mean though that we can't trade either that consolidation for the swings and the lower time frame stuff, because we could be a scalper. But if we were analyzing the market in terms of bias for what's going to happen, maybe tomorrow, the next 2 days, or into the whole week or into next week, the bias is coming from that daily, 4 hour, and possibly even the weekly chart. Okay, so
Okay.
one time frame's retracement is another time frame's reversal, or one time frame's reversal is another time frame's retracement. One time frame's consolidation is another time frame's range, because while this could be what it looks like on the 4-hour chart where it's just trading up and down here, these it's trading sort of in this range, so that's like a consolidation. But these big moves down and up moves, that's like expansions on
Yes,
like a
I
5
do.
minute or
Yeah.
a 15 minute or whatever lower time frame there would be in that 4-hour chart. So you really have to understand that each time frame is a fractal of another time frame. So if you think about how many 1-hour candles is a daily chart, well, it would be 24 candles would give you one daily candle. So you just see the one daily candle of possibly the wick and then maybe the body, something like that, very crude depiction. You don't see all of this 1-hour price action in here. You just see this big up body candle or down body candle, high or lower, and that's all you see on the daily. You don't see the individual units of price action on the 15 minute, the 5, the 1, the 4. You just see a candle. Now that's where we use the term fractal, because while there's a fractal of this time frame, and the next day would open, likely if it was a down candle somewhere over here, maybe this whole area over here is a void that closed down, because that would have been a liquidity void possibly. And if price is going to open up here, it likely could retrace to close some of that void. And maybe on this lower time frame inside of this daily, there could be like a 4-hour order block, a lower time frame something, more things you'll learn later on. So it would close maybe some of that void, and then because it's already expanded, this is a retracement, and then we can expect price to expand lower again, something like that.
Okay.
So
Okay.
that was a very detailed explanation, I think, but maybe more than what you were looking for. Hopefully it answered some of your questions, and if it didn't,
It
maybe
did.
just write down some more questions. But I believe that if we continue with the process, you'll undoubtedly answer the questions you need to answer.
Yeah. All right. Cool. Thanks. I'm happy for now.
Okay, perfect. So let's just have a look here. So back over here, we need to continue, guys. So we can't be delayed too much longer, because otherwise we're never going to be able to go through these ideas. So we said that we were just going to move over here. So this is now really the approach of what is that we are going to do in terms of how we're going to approach trading and build the confidence that we need to actually take trades and not just build the system the whole time. So as long as this should be, I also need to make it shorter so that, no one dies of boredom. But essentially, the next thing that we need to understand is an impulsive price action. Okay, so an impulse price action is, let's just look over here. So generally an impulse price action is something like we can basically see over here. Let's just get a clean chart here so we can stick on that pair. That's Euro GBP. So an impulse price action is on all time frames. Okay, so an impulse price action is all over the chart. So impulse price action over there. Let me just change this over here to like this red here. Okay, so there's an impulse price action over there. There's an impulse price action over here. There's a lot of impulse price action. There's an impulse price action down over here. There's pretty much impulse price actions all over the place. So there's an impulse price action. Basically, an impulse price action is a large move, higher or lower, that creates porous price action. Porous meaning open. It's not efficiently traded. So when price comes back in and closes some of this void that gets created, that's pretty good efficiency. And that is not really as porous as it would be over here, for example. Okay, so we are saying that an impulse price action is a large liquidity void. And when we say impulse price action, obviously it's also again fractal, so we can identify it on a 5-minute, 15-minute, but generally if we are following bias based on a higher time frame, we want to be using daily and weekly charts and possibly even monthly to see impulsive price action movements, because that is identifying the market makers or the institutions and their orders that they are pushing price in a particular direction. Okay, so that to us is impulsive price action, and I'm just going to use as a reference point the daily chart, because that's one of the best time frames to trade from based on any sort of scalping or day trading strategy. Daily is pretty good. It's a blend of, not too high, not too low of a time frame. So we want to identify an impulsive price action. So essentially that's pretty much like I said, anywhere, impulsive price action. Impulsive price action all the way up here, impulsive price action. So these are, like we said, reference points for price action. Liquidity voids. Impulsive price action is basically a liquidity void, and that is generally what we want to use as a reference point when we want to make the decision of where to initially, once we're learning, pulling a fibs, because we'll know probably how to pull a fibs. You can anchor a fibs on wherever you want to anchor a fibs. And why do we anchor a fibs? Well, maybe you want to use fibs for equilibrium and discount, equilibrium and premium, deciding what range to trade in, where's the discount, where's the premium. Okay, so we're going to learn more about that and how that affects the marketplace. But impulsive price action, specifically what we are talking about, is a move that is impulsive. Like if you Google the word impulsive, meaning like something just happens out of nowhere. It's impulsive decision making. It's impulsive. It just moves quickly. Okay. It doesn't have to be quickly because it's obviously a daily time frame, but it's impulsive, and you don't want to see with an impulsive move like rejection, meaning let's have a look here if we have an example of that. So based on the daily, so here would be an impulsive move to the upside, for example, but then followed by that sort of impulsive move to the upside, it didn't or wasn't able to close that much higher. So generally with impulsive decisions on a higher time frame, if it's impulsive, then it should allow itself to close higher or close lower based on the direction it's impulsively moving to. So in this over here, it impulsively moved higher and it rejected over here, as we can see. It didn't actually close higher when it was an impulsive move. So if this was a liquidity void and we were going to trade it over here, this rejection, as we would call it, a rejection block, didn't allow price to close higher. So those kind of scenarios to identify impulsive price action is a no-go, and you should be identifying what the higher time frame trend would be so that you would know which way the market should impulsively move, either to the upside or to the downside. So that is something that we need to know, the terminology of an impulsive price action move. Okay, so banks set the price of currency, obviously, because when we trade currency, banks is the manipulators of that, but not only limited to currency. Obviously, they can dabble in everything, whether it be gold, oil, whatever. They have the ability to transfer funds, accumulate orders, distribute price of anything, whether it be even Bitcoin, oil, stocks, bonds. They are the prime candidates to manipulate price on any chart that we are looking for. Okay, so price is delivered to engineer efficiency for smart money. Okay, it's got nothing to do with retail traders. They are not the people they are targeting. Institutions target hedge fund traders because they are the ones with large hedge funds. They are the ones with more money. So they're not targeting retail traders because hedge funds still trade with the likes of moving averages, trend lines, harmonics, VWAP, you name it, volume profile, whatever, holy grail. They are using those things too, and obviously they do work. I'm not saying they don't work, but the hedge funds are using those ideas, and that is where the banks are targeting those liquidity points. Okay, so sometimes price could impulsively move in the opposite direction and then reverse, where there would be pending orders or resting liquidity, either to the sell side or the buy side liquidity. Okay, so as an exercise, guys, we need to do this, and this is we'll have to do another recording. This one will be over in a few minutes, but this would be your homework to practice. Okay, probably some of you are familiar with this, but this really lays out what it is that we need to do starting out. Okay, because if we're going to be trading, what we're going to be doing with ICT, we need to have some sort of foundation as to what should we be doing, not just looking at text and reading, but what should we be doing on the charts. And it's pretty easy. Okay, it's basically for your journal. It's to research how the market does what it does at specific levels, on specific time frames. This is really that stepping stone to looking at charts. Okay, so basically you can do all four of these charts, which is the daily, the 4 hour, the 1 hour, the 15. You can do all four of them, but generally I'd say do at least 2 of them, or all four. It's really up to you how many you want to do. And the purpose of the exercise is to identify where areas of price action has moved quickly. Okay, so identify areas where quick movement has occurred from a level. Okay, like we said with impulsive price action. So identify where there was impulsive price actions. Number 2, identify untested recent highs and recent lows. Okay, so why would we want to do that? Well, because if it's untested and price moved away from that high or that low, there would be resting orders or buy side, sell side liquidity sitting above those swing points. So that is why we want to identify those. Okay, we also want to identify, as we know, what EQH and EQL stand for, which is equal highs and equal lows. So we want to identify that, because if we think about what equal highs and equal lows are, generally it is a W pattern or an M pattern, and that is like one of the most common things that retail traders look for, is because they say that a W pattern is a buy pattern and an M pattern is a sell pattern. Now, it's not the pattern that's making it sell, it is the engineering of liquidity. So that is what the exercise for us to identify what the equal highs and equal lows are. And there's no point marking out equal highs and equal lows of charts that's made those 10 years ago. You want to be doing it on recent price action. So that's why we're sticking to like 4 hour, 1 hour daily, recent price action, not weeks and weeks ago, because if it's far away from current market price, it's irrelevant right now. It's relevant, but not for the exercise part. Okay, and then as we know, we want to know what days do high of the week and low of the week form. Okay, so this is an exercise for you to go and look, maybe do it over the last month, last 2 months, 3 months, or this year, or however long you want to choose. But the point is, what days, without me telling you, do the high of the week and low of the week form? Okay, and in which kill zone are they? Are they in like the morning when the London opens, or are they later on in the New York when the New York opens? So you need to identify what days do the high and the low of the week form. That is your exercise for you to do before I tell you the answer. Okay, where is high of the day and low of the day, and which kill zone? Okay, so easy. You just go and look which days has high of the day, low of the day, and which kill zone. Simple. Daily chart, noting the most recent highs and lows where price action has accelerated from. Simple. 4 hour chart, note equal highs, equal lows, and also where price accelerated from. 1 hour chart, same as the 4 hour and the daily. That is your homework that you need to do for me. And if you don't do it, then that's on you. But I'm just saying that this is the stepping stone for that. Okay guys, so basically we're just going to continue straight away here. I'm not going to waste any more time. So that is your homework. It is the purpose to have some information for you to work with in the coming weeks, and that is the exercise that we need to do. You can always just ask questions on email or Telegram, post screenshots, ask whatever you want to ask when you need to ask it, but that is your homework. You need to do that for me, or do it for yourself, not for me. And that is the purpose. If you have reasons, or why are we doing what we're doing, well, then always ask, but that is the homework, so you guys should go ahead and do that. Okay, I'm not going to spend more time there. What we need to do first, okay, before I start this section here, Emmanuel, you have a question, go ahead.
Yes, good morning. Good morning, everyone in the class. I hope you're all well. Uh, I heard you talk about the killing zone. So I have problem on applying killing zone in the chart. How do I do that? There's a way you can show me an example, maybe.
I think we're going to address specifically kill zones later on, Emmanuel, like what time to set and how to identify it and things like that. Just know that.
Okay.
Do you know what a kill zone is?
I have an idea. Yes,
Okay,
it's
so basically it's the London kill zone and the New York kill zone. Or if you
yes.
wanted to, people even say the Asian kill zone, but I don't trade that. So most people
Okay.
don't either. They either trade the London kill zone or the New York kill zone. It's obviously at a specific time of day, like for 1 hour or 2 hours, depending on where you live. The time is going to be
Okay.
different. So for my time kill zone and your time kill zone is going to be different, but it's obviously all happening at a specific time because it's relating to the London markets, and obviously that's based on GMT. So GMT 8 a.m. is when sort of, the London market moves, because 8 a.m. on a Monday to Friday is when, business opens for banks or just general business. So we refer to as in that time zone or that specific time range is when the kill zone happens. But don't worry too much about, how to apply it or what exact time we should look at. Just know that the kill zone is either the London or either the New York for now. For now, it's not that important to know specifically what time should we sit. Okay, just know that it exists, and I feel like for now that's enough to know. You don't need to know precisely more. Just know that if you are going to do like this homework piece here, where it asks you what days do high of the week or low of the week form and which kill zone, you're either just going to answer, okay, well, today's high formed in the New York session. It doesn't have to be the kill zone specifically, but just the New
Okay.
York session or the London session. And then that's either the high of the day, low of the day, high of the week, low of the week. So just which session it formed. That's really more important for now.
So all this session, it's a New York session or London session. They're all in the chart, or it's something that also we have to apply in the chart.
Well, you would know when the New York session opens for you, because that would be the second or the third session rather of the day, because you'd have your Asian session first, then you'd have your London, and then your New York session. So you must just know that you can go, and I can send you a link of where you can go to look what time the market opens in your time zone,
Please.
and then you'll know. Well, I'll just add it here. You'll know, like, okay, this is the New York session, or this is the London session, or it's both, because sometimes at specific times, until a specific time, both London and New York is open at once, and then obviously the London will close, and then New York will still stay open. So there's actually like a little another mini kill zone when the London market closes. But that's really relevant for now in today's teaching.
Okay. Thank you.
Okay, so there was another hand up, but it disappeared now, so I don't know who it was for. Okay, guys, so if you do have a question, I'm sure it will be answered. So what we need to do over here is understanding what would be the baby steps to identifying institutional order flow. That's what IOF stands for, is institutional order flow, IOF. Okay, most of us know what that is. Okay, but like I said, with the impulsive price swing or price move, that's where we are starting this reference point. Okay, so where is this IOF coming from, the institutional order flow? How do we start to learn about it? Or how do I, if you've watched my YouTube videos where I talk about, order flow and 4 hours and daily and marking up those time frames, how do we get to that? How do we, although that's the order blocks and all of that jazz, okay, how do we get there? How do we formulate the idea of what direction we should trade in? Okay, and that comes by the process of learning. We can't just jump to that conclusion that it must sell or it must buy. Okay, so going on, we refer to this as the baby steps to order flow, meaning it's not actually like the order flow, but in order for us to understand institutional order flow, this is one of the steps to get to that decision-making process. Okay, so obviously we need to, we would wait for price to influence our decision whether we want to buy or to sell. Okay, so I'm going to discuss buying scenarios specifically, but obviously if it's sell scenarios, then it's just opposite to what we talk about in buying. Okay, so like I said, impulsive is displacement. Okay, impulsive price action is displacement in price action. So the old term, if you've ever watched ICT, always uses the same reference, and I like to too, because this is how I learned. He talks about if there was a small swimming pool of a child and an elephant put its foot or both its feet inside of the swimming pool, what would happen? The water would overflow because it is displacing the current volume capacity of the swimming pool. So the swimming pool is 400 liters, and now this elephant puts its feet in the swimming pool. It is exceeding the volume capacity of the swimming pool, and the water overflows. So if you ever did science in school, you'll know specifically what I'm talking about, that this is displacement of that water. So in that case, we are referring to price. So that impulsive price action, or that liquidity void, based on the higher time frame that we see, that is that displacement that we see. Okay, so generally, either we are expanding or creating that liquidity void, okay, because it is order flow and price is expanding in a particular direction. But if we think about how price moves, generally price is moving to some objective in one shape or form of another. Maybe price is bearish on like a daily, bearish on a weekly, and we look on the monthly and we see, oh, okay, price would likely head here because it's pretty obvious. Okay, so while we say that it goes into a position of liquidation over here, liquidity pools to liquidate the orders who accept higher price offering. Meaning, what does that mean? Well, basically that expansion or that liquidity void, that displacement in price that we see, is either price expanding in the order flow, but at the same time, when it's expanding into that order flow, it's collecting up liquidity. And oftentimes price may expand into liquidity as a retracement, like we said, or expand up into liquidity to reverse. Okay, so this is where that whole IOF thinking process, we're putting our thinking caps on now and we're trying to get to the decision of what is this order flow. Okay, so this is how we identify that. Okay, we are looking at a 4-bar candle swing over here. Okay, 1 candle to the left and 3 candles to the right. Okay, so let's have a look here on a daily chart what that would effectively represent. Okay, so, and we're going to do it specifically on a daily chart, and we can see that there's a couple. Okay, but generally we want to use the daily chart. You can use a lower time frame too, but generally daily chart would be really your go-to for understanding this baby step to institutional order flow, because it has higher time frame significance. So based on what we see over here, it's pretty easy to identify where impulsive price action has occurred. So the first level, obviously, there was this level over here. There was an impulsive price action higher. Okay, so price expanded higher. And like we said, for that homework piece, where did price expand into? Well, it expanded from obviously down here. So if we look at what price did, it would have raided out this liquidity over here. So I'm just going to put that in red so you can see it more clearly. So there would obviously be liquidity here, resting orders below this consolidation over there, and then price decided to come lower, knock out the sell side liquidity, and then reverse. So price, as we see here, it expanded outside of this consolidation, and this is expansion, and then likely the higher time frame suggests that the weekly is bearish, so this daily expanded into the weekly that's bearish, and then price went and expanded lower because the order flow was bearish, so it expanded. Okay, and then over here price bought underneath these lows of generally where it should, because that is sell side liquidity, and it expanded higher. Didn't quite take out the high over here. So what did it effectively do? Well, because it didn't take out or failed to take out that high, there would be liquidity sitting over here, and now more liquidity sitting over there. Because while that is not equal highs, it is relatively equal highs. So we would know that when price moves away there would be liquidity, and price obviously coming back up, creating more liquidity by not taking out the high and then retracing lower. So it expanded, or first it expanded, retraced, expand, reverse, expand, consolidate, grab some of this highs over here, engineer new liquidity, retrace, expand again. What is it doing? It's expanding into where liquidity would be, and then price, what does it do? Reverses at what? Liquidity. Okay, then what happens? Reversed, expands down into what? Well, this would be where that impulsive price action occurred, so there'd be an order block there, and then price decides to continue higher over here. So when it decides to move higher, this would be where liquidity would be now. Why? Because it took out this liquidity and it took out this liquidity. So that's part of your exercise. Where's the swing highs? Where's the swing lows? 4-hour daily, 15-minute. This is your goal, or your objective is to look what liquidity in the market is doing. Because before we discuss liquidity as such, you need to look where these highs are, these untested highs, untested lows, and once you start to gather the picture of how price is moving and what it's doing based on these points of liquidity, then you can understand what internal range liquidity is, external range liquidity, because there's no point in me telling you all of that right now if you just don't see what I'm showing you here. So obviously it took out the liquidity over here, and while it took out the liquidity over here, it did not take out the liquidity over there. Then price bought underneath the sell side liquidity, and it's still trading. Okay, I'm not going to say the word, or maybe I should, but from this low to that high, this is internal range liquidity. So this swing low over here is internal range liquidity, and then below that low would be external range liquidity. Okay, but don't worry too much about that right now. It grabbed that internal range liquidity of that swing low, and then price reversed underneath the low over here, and then it expanded. Where is it going? It's likely going for this liquidity, possibly liquidity onto the left of the chart, we don't know, and then price expanded. Okay, so the purpose of what I'm showing you here is to identify areas of expansion. So we said that this was the first area of expansion over here, and then we said that there was another area of expansion over here, and before price took out this high and this high over here, there was another expansion down here. So really what we are doing is we are saying, where is this impulsive price actions coming from? Now, you can just select on this chart just by looking at it which impulsive price actions you want to look at and what sort of sentiment you want to participate in, being a bear or being a bull, to say buy or to say sell. Now, no one's right, no one's wrong. It is your perception of the market that makes you decide what bias to have. And yes, sure, you're going to be wrong, you're going to be right. Sometimes I'm wrong, sometimes I'm right. So at the end of the day, there's no right or wrong answer to the bias, because the market eventually can most likely move against you if you are wrong, and if you're right, you'll get it right. But at the end of the day, what is right and what is not subjective. So subjective is the part where we say that no, price is going to go up, no, price is going to go down. That is subjective, whereas the objective part is the impulsive price actions that we see. That is objective. It's there. It's either impulsive or it's not. It is not like, no, we can't, argue that these are not impulsive price actions, because they are. Okay, that is objective, whereas our bias based on whatever time frame, that is subjective, meaning it is our process in our minds, our logical way of thinking that decides should we buy, should we sell. That, so like someone scalping versus someone intraday trading will have the subjectivity of being a bull or being a bear to buy or to sell. That is their decision to do that, whereas this is objective and it's there on the charts. It's like a yes or no question. Either it's impulsive or either it's not. So going on, what is the purpose of, looking at these impulsive price actions? Okay, so when we look at impulsive price actions, we are saying to ourselves, where are these institutions buying? Okay, are they buying or are they selling? And based on the chart that we are looking at, we can see that they were selling. Okay, there was an impulsive price action to this downside over here, and then price decided to sell. It retraced and expanded lower. So there's really, depending on if you're a buyer or a seller, there's opportunities for everyone. Just know that obviously we should be selling in a premium and buying in a discount. Okay, and how do we get these premiums and these discounts? So one of the first things you learn as an ICT trader is this impulsive price action. So we are looking at the chart to say, where is the impulsive price action? So I've basically highlighted a couple here, over here, over here, and even over here. There's actually one over here. There was an impulsive price action over here, and we can see that price failed to take out this swing high over here, and over here there was some equal highs, and again another impulsive price action to the upside over here. So that is the baby step to understanding order flow. Okay, and the purpose of the exercise that you're given is to identify untested swing highs, swing lows, equal highs, equal lows on those daily charts, so we can see where price is likely to want to go to based on where the liquidity is. So if we look at what price did, it came down lower over here and targeted and reversed from this point over here. Let me just change this to red. So price reversed here. Okay, so when it reversed here, took out some liquidity, but also I know this because I follow this chart on a monthly time frame. This was external range liquidity. So you can see here, this whole area was consolidating in this monthly over here. And then when price came lower over here, what is it doing? It's grabbing the liquidity over here and over here. And if we look at what price did, it traded into this void. Now people will say, oh, but it should come into this void and close it entirely. Not necessarily, because of all of the price action that occurred here. Where would higher time frame analysis come from in terms of orders resting or pending from the hedge funds? Well, they would be below these lows, where there would be sell side liquidity below these lows. So that is what we refer to as external range liquidity. And you can see there, as price tapped into that external range liquidity, only then did price reverse. And the reason for that is because that is where liquidity was sitting, on the sell side liquidity. You'd ask me, as ICT always says, who the hell is going to have sell stops resting there? And the answer to that question is the hedge fund, long-term hedge fund trading. They have sell stops resting there. So that is who they are targeting, and they are able to buy up those sell stops, because one sell, when that sell stop gets activated, someone else is buying that sell stop. That's when one person buys, another person sells. When one person sells, another person buys. So think of when you go to the shop. You are buying a product and they are selling you the product. So if you go to the shop and buy milk, you are buying that milk, but the shop is selling you that milk. And that milk at the shop, they had to, in order for them to sell you that milk, they had to buy that milk. So there's that whole like supply chain type of scenario, and who creates the milk, at the farm, and the animal, there's that whole listed order of who is buying and selling what, and as it goes later down in the line, that milk costed whatever $1, and at the end retail trading price it costs $4, for example. So the same way of thinking needs to be thought here, not in terms of supply and demand, because it's not based on supply and demand. As if you want to think it is, then you're wrong, but it's based on orders. Okay, who's buying and selling what, and who's taking those sells to take the buys, and who's taking the buys to take the sells. So that is the purpose of the exercise. And the purpose to understand institutional order flow is to identify these impulsive price actions to the upside or to the downside. Now, if you look at my Euro GBP chart over here, you'll see that if I go to a daily chart, I mark out liquidity points and where price would likely target all the way back. Okay, you'll learn why I do this later on, but for now, just understand that over here there was liquidity based on even the weekly chart. We could see over here there was this trend line, and I'm not trading a trend line, that is liquidity, and there was some equal highs over here, and you can see there basically price taps into that liquidity point over here, and then it reverses. Why? Because there is buy stops here, so long-term followers or retail traders see, okay, well, it's breaking this point of resistance, so therefore it's going to be a breakout. They buy it at an expensive price, and then price sells. Why? Because there is willing participants to buy, and those buying participants were sold to. So that's what's happening here. Okay, it's a case of either they're selling to the buy stops, or any positions that institutions took in some kind of discount, they will be exiting those positions in a premium, because they don't continue to buy, they retrace price, and when price retraces, then they buy again at a better discount than current market price. So that is the purpose. And then I said, yeah, we are looking for a 4-bar candle swing, 1 candle to the left, 3 candles to the right. So think of it like your fingertips, where there's the first bar, the second bar, 3 and 4. So it makes a fractal, a swing point fractal. There's actually an indicator for this, but it doesn't actually work, which is the Williams fractal or something like that. That just basically puts the fractal points of price action, and that's not what we're looking for. We are looking for fractal swing points. So 1 candle, 2, 3, 4. So here is a swing point. 1 candle, 2, 3, 4. It is a swing point over here. You want to see price swings. If anyone has a question about this based on fractal swing points, I will address it, but I'm not going to spend too much time on that specific subject. But basically, when there is a fractal swing point, that is likely a move away from some level of premium back into a discount. What is discount? Discount is anything below the current trading range in the 50%. So let's just go back to this clean chart here. So whenever price makes a swing point, price is in either premium or discount of that specific range. So when it made a swing point lower over here, there is equilibrium over here, and price did not retrace back to equilibrium over here. It came close to equilibrium. Okay, it also closed that void, and then price decided to expand higher. So each time price is making these expansions or these displacements of price, there is a new price swing, which gives us new data, which gives us new premiums and new discounts. So although there was this discount over here, made a swing high here, pulled back over here, and we said, oh, well, we'll wait until price comes into OTE or discount. It never did that. Then it made a new price action over here. Okay, same scenario. Well, if that's the case, then our new price swing is over here. So we'll just wait until price makes a top out and it retraces lower, and we will only buy in the discount, which is this section over here. And then once it's in the discount, then we will only buy. So this is the whole idea of understanding institutional order flow. There is institutional order flow on monthly, weekly, and daily, which you'll learn more about in the coming weeks. But this is the baby steps to understanding that, is looking for these displacements of price. What is it doing to the liquidity on the left of the chart? And where is new liquidity on the left of the chart? Because although if we zoom out here, what did price do? It expanded higher. It expanded higher into what? Higher time frame liquidity of this little trend line over here. And at the same time, taking out all of that liquidity over here, what is it doing? Well, if we look at how retail traders are thinking, there is another trend line forming here. So as price is making higher highs and higher lows, as the word goes, I am not looking at higher highs and higher lows. I'm looking at the fact that while it is doing that, it is engineering new liquidity over here, over here, over here, and over here. Not because of the trend line. I just know that I can see with my eyes that there is a trend line there, not because I'm trading a trend line, but or that the fact that it's breaking the trend line. So if we were to say, there was a trend line here. Oh, it broke the trend line. I'm going to sell now. We are not selling because of the trend line. We are selling because of the idea behind the trend line, because there's liquidity as it's making higher lows, that there would be resting orders. So this would be a target for price to sell from this level of premium, having gone up, back into a discount, and from one level of discount to one level of premium to the top over here. And that's how price would effectively move. It moves from one level of discount to one level of premium, and from one level of premium to one level of discount. Now, that does not mean, like we saw here, that when price made this move from this low to this high, why did it not come back into a discount over here? Well, the fact of the matter is that it expanded aggressively away from here. It showed displacement. It did trade into a discount because this is already a larger time frame discount. And the fact of the matter is, if we say that we are only buying in discount, this would have negated the fact that this was a trade setup here, because this did not retrace into a discount for a buy. So then we just wait for the next leg of price action, and over here we will be a buyer because it is now inside of the discount. So that simple approach to that rule, that we should only be a buyer in a discount or only be a seller in a premium, is really where we lay the foundation of what order flow is, or institutional order flow. Impulsive price action makes a high, takes a high, reverses a high, and then it retraces, and then that's where you fill in the blanks, like what is the order flow based on the monthly, based on the weekly, based on the daily. And this is the guidance for that, identifying, like we said with that homework exercise, where's the swing highs, where's the swing lows, where is it likely to target liquidity, etc. And that's basically what I did here, is that on this GU, if we look at what the chart's doing, we said it took out all of this liquidity over here on that higher time frame target, but at the same time, when it took out this high and this high, we can see that it was going to target these lows over here. That was the first target over here, and the second target should likely be these equal lows over here. And if we also look here, there's actually a consolidation over here, and above a consolidation and below a consolidation, not to mention the relative equal lows that's formed here, above and below a consolidation sits liquidity. Okay, so that is also a target for price, is to grab that liquidity. So if we were to say that, okay, well, we were a buyer, but now our bias should shift and we should be a seller. Well, if we are a seller, where would price likely want to go to? Okay, so that's how liquidity helps us to understand where the market is heading. And if you can understand and have a good grasp on liquidity, you're going to be wrong less than you are right. So you're going to be wrong 40% of the time, be right 60% of the time, because that's just how it is. And just by understanding liquidity as a base core for whatever strategy you have, then you will be fine. But in order for us to understand liquidity, we need to understand this baby step of impulsive price action towards liquidity, moving away from a discount into a premium, or moving away from a premium into a discount. And we said that there was a 4-bar fractal swing. So like I said, I'm not going to go into too much detail about the 4-bar fractal swing, but basically that's your swing point. So whenever there's a 4-bar fractal swing, so like here, unless you had marked out the liquidity, that would not be a 4-bar fractal swing because it made a high, made a low. So that's not really a swing point. However, it is an anchor point for a premium and a discount because it made this low, made that high. So within this low and within that high is some kind of premium over here. Now I have my own premium and discount decided by the IPDA data range, which is something much later we'll get into. So don't really worry too much of what's really happening over here on this, but that is my own premium and discounts. So don't worry about that. But essentially, we need to know what is the swing of the price as to where is the impulsive price action move. Okay, that's really what we are doing. And then if we are a buyer or if we are a seller in this specific teaching, I'm talking about buyers, if price is in a premium of a particular impulsive price action, and if it's in the premium, we do nothing. We only are a buyer, or our bias is only to buy. We do nothing. We don't try and sell into the discount because we don't know. We wait because our bias tells us it's bullish. We wait and we do nothing until we are below equilibrium. So in a case like when it traded higher over here and we pulled the fibs from here to here, there would be no setup here because it did not come into equilibrium. And that simple rule, okay, as part of your trading system, is to, where's the impulsive price action? Am I a buyer? Am I a seller? That simple rule, that if it's not below equilibrium for a buy or above equilibrium for a sell, then that simple rule can help you many times just by implementing that simple rule or that way of thinking. Okay, we do nothing. Once price is below or above equilibrium, if the institutional order flow is bullish in this case, price will not stay there for very long. Okay, so if we look here, it obviously didn't even come into equilibrium and expanded away again. But in this case over here, when we had this swing low generated and this swing high, and when it returned back into the equilibrium part, it didn't last very long before it expanded away again over there. Okay, so that's just something we need to think about if we are a buyer or a seller and we've identified the correct bias, that if it's bearish, it's not going to stay above equilibrium very long, and if it's bullish, we're not going to stay below equilibrium for very long. Okay, what we can essentially also do is the following, and that is referred to, you've probably heard me say this, but this is a double discount over here. So it's a very simple application. So I'm just going to get a quick clean chart over here to show you of just anything. Let's just take this CAD JPY and impulsive price action. So obviously there was an impulsive price action over here. There was an impulsive price action over here. Impulsive price action over here. Impulsive price action over here. And impulsive price action over here. Now obviously the order flow is bullish based on monthly, weekly. So every time price was doing this over there, and only if it is below equilibrium, so here would be equilibrium, we are looking for a buy. Here would be another point over here where it made a swing low to a swing high. We'd be looking to buy below equilibrium. And if we're bullish from sort of this range over here, something like that, if it's still remaining bullish, then we'd be a buyer at the equilibrium. So something really rough like that. And double discount really refers to that once it's at that equilibrium point or near that equilibrium point, we are essentially coming down to the lower time frames of whatever's lower than your daily or whatever, 4 hour, 1 hour, whatever time frame you want to use. And this whole section of price becomes a discount for you. So if we reverse back here again, this would be the whole entire discount over here. So everything inside here, order blocks, voids, everything you'll learn in the future, maybe propulsion blocks, rejection blocks, mitigations, any maybe trading strategy you have or you want to improve can be built upon this, and that simple rule is double discount. So you identify a swing high, identify a swing low, and then if it's sitting below the equilibrium, you'd come down to a lower time frame and get a double discount. So we knew that it traded lower here. You'd pull a fibs from the recent swing low to the recent swing high, and then again you get another discount inside of the discount over here. So it's simple rule, and if you guys have more questions about that, it's really easy to look at. You know, either it is in a double discount or it's not. So again, it came into equilibrium over here, didn't spend too much time below the equilibrium point, and then it reversed. So we're looking at the 4 hour, and the recent trading range is something like this. And if you miss that entry again, it's below equilibrium here, and then it traded higher. And then if you try to take this one over here, you would have probably been stopped out, but the order flow is still bearish, targeted this to liquidity points over here and over here, and filled in some of this inefficient price action here, and then it decided to trade higher. Again, not trading very long below this equilibrium point over here. And there's obviously, you know, I'm just showing you on a 4 hour versus a daily, but I mean, you could do daily to 1 hour or 4 hour to 15 minute or whatever. I'm just teaching you that you get your double discount based on which directional bias you want to apply. And your directional bias should come from your dailies, weeklies, and your 4 hour, really depending on, are you intraday, swing trading, position trading, scalping. You know, obviously if you're scalping, then you're going to more refer to like the 4 hour chart and the daily than, you know, what's really happening on the weekly, because you like in out before the session finishes for the day type of thing. Whereas if you're day trading, you maybe want to hold into another session or maybe into the night, etc. So that is your double discount. And there's not much more to this. If we have any further questions over here, we can identify it. So I'm going to move on to the next one, which is fair valuation. Okay, so we're going to just end off this now by saying that what we spoke about in terms of what is the order flow in terms of how we get to that decision, it's important to understand that in order for us to get to that decision based on the daily order flow, the weekly, the monthly, etc., we need to understand how do we get there using this baby step to understanding that, and that is understanding where is the discount, where is the premium, and if this is a discount, why is it a discount, and if it's a premium, why is it a premium, and based on what our exercise will be regarding this understanding where liquidity is, untested highs, that's really what sets us apart now by understanding those items. So without further ado, I'm going to continue now. Anyone that's not in the group right now or the Zoom can or must watch it later to understand what we're talking about. But just to finish or wrap up what I was talking about in terms of premium and discount, I was saying last before we ended that the double discount is based on, say, a daily, and then you're going to a lower time frame to find, you know, the discount of the particular current trading range of the swing high and the low. And one of the questions I always get is, do I use the bodies or do I use the wicks? So for this particular exercise, you would be using the swing highs and the lows of the wicks. But later on, you will learn more intricate details as to when to use the wicks and when to use the bodies. Now, there's no right or wrong way to do it. It's the fact that once you've stuck on a particular way of if you're going to use the bodies or if you're going to use the wicks, then I suggest you stick to that. So that's what I generally say is, if you're always going to use the wicks, then always use the wicks. Don't chop and change between the two. Stick with one and stick with it throughout, but don't get too comfortable by using only the wicks now, because later on we'll learn why we should use the bodies instead. Okay, so I need to continue, and what I'm going to continue with now is based on what we just said about equilibrium and discount. So one of the key ideas behind possibly a reversal, okay, is the fact that when price is in a discount of a particular range that we've identified, it is very likely that we will get a turtle soup buy model under old lows if we are in fact bullish. Okay, so turtle soup buy model is basically a turtle soup, but because we're in a discount, it is a buy model, TSBM, turtle soup buy model. There's obviously the reverse to that, which is TSSM, turtle soup sell model, if we are in a premium. So what we are essentially saying is that if we are in a discount, we would like to see reversals underneath lows, because that is a turtle soup buy model. So going back to the chart of Euro GBP, anytime price is making a low over here, so let's just get a clean chart of this. This is Euro GBP and the daily over here. So let's say we identified this particular range over here, and this is our OTE. Now I said equilibrium and lower is where discount is, but in terms of turtle soup territory, we are looking at 79% and below. So anytime price is in 79%, there is turtle souping potentially going on over here, and that can be seen on a lower time frame. So if you want to see reversals based on a higher time frame, you're going to come to that specific area, and any lows that are below, either at the 79 or below, it's likely to get reversals, especially if we are in a bullish order flow based on a higher time frame. If we are in a bullish order flow in a higher time frame and price is now retracing below OTE, below 79%, this is turtle soup territory. So you can see how price reverses over here below this low. Once taking this low, price then reverses over here, and that is because that is where orders are sitting and it is bullish, so they are collecting orders there. Now that's a small consolidation, that's a small swing point, whatever you want to identify it as. Obviously there's liquidity there, and as price moved away, when it gets here, more liquidity. When it retraces here and moves higher, people buy it. So what do? They either put their stop there or here if they're buying, and more liquidity gathers. So as price moves away there, and the longer it stays away from there, more liquidity is engineered. And obviously as it is engineered there, it is engineered there, and it is engineered there. So obviously those two are liquidity points, but because we are already bullish and we've already moved into quite a deep retracement of a discount, this is a turtle soup over here. And it's really the same sort of idea that if we were double discounting, that any particular trading range below equilibrium into the 79%, we would get another turtle soup over here. So if we've already turtle souped over here and price has reversed and gone higher, consolidation, expansion, retracement takes out the low here. It doesn't look like it takes out the low, but it does based on the closing price over there. Obviously closing price has got liquidity on it as much as the wicks do, which you'll learn later on about internal external range liquidity. So grabs the liquidity and then reverses over there. So this simple idea is our approach to what we can see in terms of a double discount, in terms of when to expect a turtle soup. So I'm not going to spend more time there. If there's questions, we can always answer them later on. But what we need to move on next is fair valuation. I'm going to send you guys a bonus video on what fair valuation is, because it's going to take a long time to explain. But basically, what fair valuation essentially means is that when price is 50%, price is referred to as being neutral. So when price is neutral, it's at the equilibrium point, and it's neither in a premium, neither in a discount. It is neutral. So above neutrality sits premium, below neutrality sits discount. And it is our idea that if we are bullish, we want to be buying in a discount. And when we are buying in the discount, where do we take profits? Well, in the opposing array, we refer to the discount and the premium as an array. So therefore, if we buy in a discount, we want to exit in a premium. So that premium could be a void that we find, an old high that gets found. We are essentially trying to think like a market maker by the fair valuation of a chart. And this too, like we said, can be part of your system. So you do a fair valuation on the market as to where we are in price right now. And if we are a seller, where would we exit the sell that we take? Or if we were a buyer, where would we exit the buy that we take? And that is the whole idea behind fairly evaluating the market. So smart money will distribute longs above old highs. Smart money will distribute longs above old highs. What does that mean? Well, that means that if they bought in a discount, they will take profits at those old highs. That's effectively what that means. And it's not always the oldest high. It could be any high where they start to, exit those trades to those buy stops, because that buy stops is the buy side liquidity. So therefore that is buy orders that are resting there. So when price goes above those old highs, there are orders that are triggered to buy, and the market makers or institutions are exiting buys that they previously took in a discount at those old highs, because that is the liquidity. And like we said, that while there is a sell, there must be a buy, and while there is a buy, there must be a sell. So that resting buy side liquidity is a target point for price. That is why we also say that that is an institutional reference point. Once price makes a high and moves away, they will allow price to retrace to engineer new liquidity. So if we think about how that works, if price is, let's say it's consolidating over here, like something like this, not so easy to see, okay, and price decides to trade higher like this, the moment it moves away from that high, immediately after, orders start to acquire or engineer over here by moving away from that area. Not only because price has expanded higher and it's maybe overbought as people would think, but as it moves away there, and the lower it goes, the more liquidity starts to engineer over here. And as it goes lower, more liquidity, because they think it's oversold. And as it goes lower, more liquidity starts to gather there. And whether it comes back to take these equal lows over here or not, and maybe just close maybe the void that was created, is irrelevant for this right now. But we know that there's liquidity there, so that if we were buying in this discount over here, then this would likely be a pool of liquidity. So our target can be this pool of liquidity over here. And when it gets there, we would exit either our whole position or a portion of our position. That is why we refer to this as an institutional reference point. So if we were buying down here for whatever reason over here, we would be targeting this range of liquidity, or maybe inside here there was an inefficient gap that needed to be closed. That too is an institutional reference point, or maybe an order block over here. So wherever we are, maybe that's a 1 to 3, 1 to 2, 1 to 5, 1 to 10, whatever it is, those are our targets. Maybe like here would be, say, TP1, and this would be like the void. Then this over here would be like TP2, something like that. And then above the old high, maybe 5 pips or so, that would be TP3. It's a very rough idea, but that is essentially the way we think about what the market is doing. When in terms of a fair valuation, we are buying in a discount and we are exiting our buy above or inside of this institutional reference point. So what's actually, when we close the buy, what are we doing? Well, when we close our buy here, we're actually selling that buy to a willing, seller, for example. So if we buy, when we click buy, okay, and we open the buy and it's in profit and it's running up here, and we click sell, our broker is buying that sell from us. And if that broker is buying that sell from us, what is the next chain higher? Well, liquidity provider, institution. So we've got retail trader, broker, institution, for example. So there's that whole chain, just like we said about the milk, where if we walk into the shop, we buy the milk and the grocer sells us the milk. That grocer had to buy it from the distributor, and possibly that distributor had to buy it from like the farm, for example. So same sort of scenario here. Fair valuation is if we're buying in a discount, where is an exit of premium? Buying in a discount and exiting in a premium, or selling in a premium and exiting in a discount. That's essentially what we are saying here. Okay, market makers will sell to buy stops their long positions they bought at a discount. This is referred to as distribution. So that's exactly what I just said. But anyway, market makers will sell to buy stops their long positions they bought in the discount. So that's the exact same thing I just said here. Market makers are buying in the discount and exiting to where there would be buy stops over here. Some or all of their position that they took. If we are bullish and price is lower than the 62 to 79% levels, we should identify a turtle soup buy model. So exact same thing I just mentioned earlier, about 5 minutes ago, is that we can identify areas where there would be likely turtle soups to take place if we are in fact bullish and price does a deeper retracement. These are the levels we can anticipate a turtle soup buy model or turtle soup sell model if we are reverse and we're wanting to sell. If we are buying or selling, you should be either in a discount or a premium, or the lower or upper 1/3 of the impulse price swing. So that just effectively means, like if we looked at that Euro GBP chart on a clean one, and we said that that over here was the area where we wanted to buy based on this swing high, sorry, that swing low and this swing high. Over here, we want to be a buyer in the 1/3. So even though it did not come to the entire equilibrium over here, we can essentially divide the same lower time frame into 1/3 of a discount. So effectively, you'd have the swing high, the swing low, and then equilibrium, but then you can actually divide that swing high and this swing low into another equilibrium over there. Oopsie, this one over here, and you get another discount. So there'd be like a premium and a discount premium, and then premium discount, and then discount. So that's effectively what we are saying here, the upper or lower 1/3 of the portion of the impulsive price action over here. If we have questions about that, you must write that down, but that's a simple approach to dividing a particular range or a trading range. Two factors for considering a fair valuation. So again, what is fair valuation? It is thinking like a market maker. Where are we in terms of market value? Are we in the 50% range? Are we in a high discount, sorry, a low discount or a high premium? And fair value in regards to the equilibrium of the trading range, because we need to have an equilibrium to differentiate between the two. If we are in fact in a premium, or are we in fact a discount? Fair valuation in regards to market makers. Okay, so obviously we are not market makers, but we are trying to think like market makers. So price action that has sudden move lower with a void, we should look for the order block. Fair value gap does not always have to be used on wicks, but bodies for more efficiency based on different brokers. So again, like I said, you should use the swing highs and lows currently of the wicks, but because there's different brokers and different brokers will not have the identical candlesticks, it is better to use bodies. Okay, but for the exercise that you are given, you should use the wicks. Later you can use the bodies for better price, but that's really what we are saying and why we are saying what we are saying about using wicks versus bodies. Fair value can be considered where there is porous price action and will want to be traded efficiently, sold off or bought up once efficiency occurs. So that goes back to what we said, that if we are identifying an impulsive price action in a particular direction and price is retracing back to that impulsive price action, that liquidity void that was created, is that impulsive price action in the order flow that we've identified on the higher time frame, or is it against the order flow in a particular time frame based on our order flow? So that's really what we need to decide, that that porous price action, and why it is porous is because it's not efficiently traded, and that is why there is such a thing as the liquidity void or the fair value gap, is because there is that inefficiency, and that's why what sort of made Michael famous was the order block and the the fair value gap. But everyone just thinks, oh, there's a fair value gap, it's going to close and then sell, or close and then buy, and that's not the case. Because there's different market conditions that need to be understood. Context of the market needs to be understood, and we are building that context and that decision thought process to be able to say that yes, when this void closes, we should anticipate a sell, because you've probably seen, if you know what a void is or a gap, sometimes the gap will close and then there's sort of nothing going on, and it just trades straight through it. And there's a reason for that. There's context behind the market for us to make the decision, should we buy or should we sell. To decide on fair valuation on market making, we should look for a break in structure that is most recent. So we'll learn a bit more about structure later on, but basically you could use the same way of thinking in terms of structure, like a longer term or intermediate term swing high or swing low that gets broken, and then that's sort of like your market structure that gets broken. Okay, so keeping in mind which area of fair value we are in based on the equilibrium, discount or premium, it is fair value for market makers to build in long positions at equilibrium or below. Okay, so what that effectively means is that when we see price trading in ranges, okay, it doesn't mean that because it's continuously going down that there is not buying taking place in the selling, for example. So it's not a case of every single order that they wanted to buy was done here. Okay, it's not a case of that. Yes, they took a majority order here, and then they allowed price to spring up. Maybe they bought again over here, but they don't continue to buy. They will exit some buys they took in a discount over here above and distribute these buy side liquidities over here, and then price will retrace because they're no longer buying, not because they're selling, but they're no longer buying. Then price will retrace because they're not buying, and then they will buy more orders. So they've accumulated longs down here, and underneath this low as well is in some kind of discount over here. And when they've accumulated enough orders, well, if they've accumulated enough orders down here, where will they likely want to distribute those orders? Well, it will be above old highs, as we saw. So above old highs over here, here, there's where they are distributing the longs that they took in a discount. It's not a case of they buy, and then they just immediately, when they get here, they sell. It's a buy. They exit buys above old highs, so they are distributing their longs in premium. That's what's really happening in terms of fair valuation. They are buying in the discount and exiting in the premium. Where's the premium? Well, the premium is really just above any swing points that's either long-term, intermediate term, or where there's a lot of liquidity. So where there's a lot of liquidity is where they would, if they bought in a discount, exit their long positions. And what you'll find is that if this remains bullish, they would likely come into some kind of discount over here and accumulate more long positions. So like maybe underneath this swing low over here is where they would likely want to maybe return to accumulate more longs, and then you'd look for a trading position, because then if we extend this whole range out here, something like this is definitely a low sitting at an equilibrium, and this would be then a discount over here. So looking to buy underneath these lows would be a good idea for price to then either retrace back the void that was created, or possibly, if it's going to maintain its bullishness, what did we say about short-term retracements? As soon as price decides to reverse, it will gather liquidity over there and over there. Okay, so those could also be targets if our bias is still remaining bullish. That's thinking like a market maker. Okay, once we start to break down the swing highs and lows, we should start to see little reaction on the stops, little reaction off equal highs in a discount, and little reaction off equal lows in a premium. So, for example, when we're in a discount, and more specifically over here, there's likely going to be, so we use the same swing low and swing high here, that one over there. There's going to be equal highs here in this price action, okay? And this is discount over here, so price made sort of this range over here, it came back into just above equilibrium, and there would have likely been on the lower time frame, if we look, equal highs over here essentially. Okay, so where there's equal highs, for example, like over here, there's sort of relative equal highs there, price just explodes through that over here. And then even before, over here, it would be a high, and then sort of like this retracement lower just before taking out the liquidity. So it would have engineered more liquidity by doing this retracement, because that would have been seen as some kind of resistance. And then boom, price explodes through here. Not only because there's buy stops sitting above these highs, but also it's exploding through here because it's already in now some kind of discount, and the equal highs, or the highs that are in the discount, have no impact or potential reversal. Okay, and it's going to target higher time frame liquidity now, because these highs are in a discount, so they'll have little reaction for reversals to go lower. So maybe sometimes you've tried to buy in a premium and it doesn't work out, okay, because you've pulled a fibs or you see an order block. And the reason for that is likely because, based on a higher picture or bigger time frame kind of thing, you're probably buying, or sorry, you're probably selling in some kind of higher time frame discount, and then that order block that you found on like the 1 hour or the 4 hour has little to no effect. Okay, so that's a very likely scenario that unfolds. So you can come through here and read what I've written out here, but this is a crude depiction of really what fair valuation looks like. And we can say that fair value is liquidating or accumulating in the market maker perspective. So when we say liquidating, meaning they're running out the stops of either buy side liquidity or sell side liquidity. Fair value in discount is fair value for buying. You'd buy in a discount, or if you were selling and price is now in the discount, you'd be exiting your shorts. Short is basically another word for a sell. So you'd be exiting your short in the discount. If price is now traded back into some kind of discount and you're a seller or in a sell, you'd be exiting your shorts. And then obviously in reverse, fair value in premium is fair value for selling or exiting longs. Okay, so if you've sold and price is coming down, just like if it was bullish, you'd be exiting in the opposing array. So if we look at what price action really did here, it consolidated, and after it's consolidating over here, it did a little bit of an expansion above this high, and then it decided to reverse and expand. When it expanded, did a little bit of a retracement, and then again, boom, an expansion over here. And then it did a bit of a consolidation, and again an expansion, and a little bit of a reversal above this equal lows here. It retraced back to this consolidation, and one more time it expanded lower. What did it expand lower into? And reverse, well, it reversed under this low, plus there was a monthly old high, which is part of a premium and discount array that you'll learn, but that is a higher time frame idea or array that it traded into, and then it reversed. And if it's going to reverse now, and if it's in a discount and we are buying in the discount and we had already sold, we should be exiting our sells. And if we are taking new long positions to buy, then we should be looking where in the premium can we be exiting our long positions. So obviously above this consolidation or above the equilibrium of the entire trading range, which would be this liquidity void over here. So like TP1, maybe above the swing high, but that's not in premium. So we'd be looking to trade into premium before we can exit that position. And then you can see a price expanded, it retraced, and then one more time did a move above these highs, and then a reversal, and then back into consolidation, expands higher, reverses above this high, trades lower, reverses below low. Why? Because like we said, consolidation has liquidity above and below. Trades below there, which is the current trading range's equilibrium, and it came into a discount, reversed underneath there, and expanded higher over here. And we can see that when it expanded higher, it sort of paused after taking this liquidity over here, and one more move higher to expand, activating the buy stops, but at the same time trading into a higher time frame of a daily and weekly liquidity void over here before going back into consolidation and expanding into the other direction. So you can see the emphasis here of marking up, say, a higher time frame, using the lower time frame to identify what kind of cycle we are in, and if it's going to expand or consolidate at specific levels, why is it doing what it's doing? Because once you can identify that characteristic, then using the higher time frame, we can anticipate where reversals could occur, where retracements could occur, basically evaluating the market as if we were market makers, exiting longs in a premium, exiting shorts in a discount. And that's thinking like a market maker. So price moves from one level of premium to some kind of fair value and into a discount, and in reverse, a discount to fair value into a premium. Okay, and then obviously price just cycles between the two, discount, fair value, discount, maybe fair value back into premium, or premium back to fair value, back to premium, and then back to fair value, back to discount. These are just some examples, and it's not specifically always what's happened in that particular order, but obviously there's no specific way at which it organizes itself, and that comes down to understanding the higher time frame as to what is essentially likely to happen. So some sort of things we can question ourselves on, what's really happening in the marketplace, and this is something we should all do to learn and get better at this, is that where are we in terms of the high and the low of the larger range? Okay, because once we can identify based on a larger range where we are, then we can say, well, if we're doing a fair valuation here, are we in a discount or are we in a premium? Because if that's the case, then it allows us to say, well, we can expect buying or expect selling because we understand what's happening in terms of the larger range. Are we working at or near an equilibrium price point between a recent high or a recent low? So generally, with an equilibrium, it's not the best place to buy or to sell, and you want to be a seller or a buyer below the equilibrium. And the reason for that is because a lot of consolidations occur at some kind of equilibrium point. Okay, so that's basically where we need to be thinking, where are we in terms of the equilibrium price point. Understanding what we learned about the consolidation, expansion, retracement, reversal, we can start to forecast what the next move will be. Okay, so like we said, we need to learn these conditions or characteristics, and once we can understand these characteristics, we can anticipate what the next moves of the market can be, because we know what the higher time frame is, we know what premium and discount is, and once it gets to these associated levels, we can, anticipate what could take place next. Try to think like a market maker. Where would they enter or exit positions? Okay, that's like market maker theory 101, is that if we are market makers or were market makers or trying to be like a market maker, where would we find enough orders where we could enter large lot sizes? Because if we think in terms of lot size, they are taking huge lot sizes. Our little 1 lots we're taking, or 10 lots, is nothing. They're taking thousands and thousands of lot sizes, and they cannot enter just one position and then hold it, because that would affect price too much. So they have to accumulate orders underneath lows, underneath inside inefficiencies. They have to accumulate a position or distribute it above an old high. So that's why we need to think like a market maker. They don't just take one order and then move the market. They need to accumulate or distribute price so that they can build in their order for a longer period of time. And this is to understand the story of highs and lows and what they illustrate to us on the chart. So it's like a story being told, really. You could go to any sort of time frame and look, like with your exercise. I feel like if you do your exercise, this is going to make a lot more sense to you. So like when you've marked up your highs and your lows, your equal highs, equal lows, discounts, premiums, and then you're looking at what price or how price reacts to these highs and lows, or untested highs and lows, you're getting a story being told as to, if it's taken this liquidity, what's it doing with that liquidity? Okay, so the general rule of thumb is, like for example, let's look at GU, okay, and over here, when it's taking liquidity, what is it doing with that liquidity it's taking? Okay, so like for example, there would have been liquidity over here because there was a low there and there was a low here. And while it's not equal, the associated level is that anyone who was a buyer there, based on this move higher and breaking the structure of the market, would have put orders over here. So what does it do? Price raids that liquidity and then reverses. Now, like I said, what is it doing with that liquidity over here? So there's liquidity here, and then it raids it. What does it do with it? Okay, well, it raids it, and then it reverses. It retraces and expands again over here. So something I can see here is that that's an old low. This is a mitigation over here because it made a failure swing to take out this low over here and then trade it higher. So it mitigated and then it expanded higher. So that's the story being told here, is that once it raided this liquidity, it was able to take price higher. And again, if it took this high, the story is that if it takes this high, then shouldn't it take this low? But no, it didn't over there. So if it took that high, why didn't it take this low? Cool, well, there we go. Then over here would be equal highs. When it took the equal highs, when it raided the high, why did it not take these lows? That's the story being told here. It doesn't want those lows, it wants other highs over here, or inefficiencies that occurred in this expansion over here. So what is it doing with the liquidity as it takes the liquidity? That is really what's being told, the story of price. Okay, guys, so that's basically it for today. There's a lot to go through here. There should be a lot of questions regarding what we've covered. But on Monday, we're going to go through the rest of this, which should paint a further picture as to what needs to be done. But that is the session for today.